Welcome to the debate. I had an uncomfortable moment recently. It's one I think many high earners will probably recognize. I needed to outsource this highly stressful, recurring administrative task that honestly would have profoundly improved my daily quality of life. It would have bought back hours of mental bandwidth every single week. And I had the liquid funds for it, but I still declined. I argued to myself that it was simply, financially inefficient and therefore undisciplined. It was only later that I looked back and really wondered, was that genuine financial discipline, or was it a quiet, kind of insidious act of self-denial, born from a scarcity mindset I can't really justify anymore?
Yeah, and that tension is absolutely central to the high earner dilemma, isn't it? It's a conflict that goes so far beyond simple budgeting. We are talking about the central optimization problem of modern affluence, this conflict between accumulating financial capital, which is, this accruable, theoretically infinite resource of money, and strategically investing in what we might call biological capital.
Right. Which, just for clarity, is the finite resource of time, health, energy, and the capacity for joy and experience. So that brings us to the core dilemma we want to tackle today. Should high earners ever choose happiness, and by that I mean present utility and valuable life experiences, over the continuous, rigorous optimization of their net worth?
And I'm going to argue forcefully that beyond a crucial baseline of financial security, prioritizing experience over this kind of relentless accumulation is actually the superior and, I think, more rational long-term optimization strategy for maximizing lifetime fulfillment.
And I will contend that continuous financial optimization is the only truly rational strategy against the structural uncertainties of modern life. It's a necessary defense that ensures maximum future optionality, control, and ultimately true peace of mind. I understand the allure of prioritizing biological capital right now. I really do. But let me offer a perspective rooted in capital preservation and, risk management. Financial optimization isn't merely about hoarding money. It is a rational defensive strategy against an inherently uncertain world. The goal of financial security is not static. It is a moving target that's constantly being recalibrated by inflation and systemic economic instability.
I agree that security is necessary, of course, but I do struggle with the idea that it's this perpetual, unattainable goal that justifies a constant sacrifice of the present.
But the evidence shows that enough is a moving target, and it's driven by external forces we can't control. We see this instability reflected so clearly in the public perception of wealth. The perceived net worth required for an American household to feel genuinely comfortable rose significantly. It went from, $624,000 to $839,000 in just the 4 years between 2021 and 2025. I mean, if the goalpost for comfort shifts by over 30% in 4 years, you just can't afford to coast once you hit some arbitrary number. And what's more, we have to actively hedge against specific high-cost sectors that inflate at these punitive rates. Since the year 2000, for example, healthcare costs have soared by 119.2%. That vastly outpaces general inflation.
And what does that mean for your optimization thesis then?
Well, it means that continuous optimization is necessary for what we might call intertemporal utility shifting. This is the capacity to intentionally move purchasing power to a time in the future when high-cost demands like specialized medical care, long-term care, or funding and education are at their highest. By optimizing now, you ensure you have the liquidity and the resilience needed to avoid being forced to liquidate assets at a loss or to compromise on the quality of care in the future. It's a sober, predictive hedge against known unknowns.
That is a compelling explanation for the need for hedging. I'll grant you that. But I disagree that the anxiety over future, unpredictable costs should completely override the reality of the present. Once a robust financial safety net is established, which, yes, is a prerequisite, continued net worth optimization encounters an inescapable truth, the law of diminishing returns. At this point, the high earner is actively trading a renewable asset, money, which can always be earned again, for a non-renewable one, your time your energy, and your physical health.
But that money buys future time flexibility, the option to retire early, for instance.
But money is fundamentally a tool. It's a means to an end. The overarching goal is maximizing lifetime utility, and that utility is overwhelmingly derived from maximizing fulfilling experiences. When you spend money on experiences, a trip, learning a skill, a concert, that investment yields what we call a memory dividend, and unlike material possessions which depreciate almost immediately, this dividend compounds. The memory actually becomes richer, more deeply integrated into your identity the more you reflect on it later in life. So maximizing this utility requires intentionally spending money when one's biological capital, or health-adjusted utility, is at its peak. This is why the strategic framework of time bucketing, dividing life into distinct stages with specific, age-appropriate goals, is so vital. You must spend while you have the physical and mental capacity to fully enjoy the investment.
I see why you prioritize experiential maximization, but I feel that approach overlooks the essential human psychological need for control. Optimization, particularly securing a robust liquid portfolio, provides a tangible psychological safety net that actively mitigates existential anxiety. And we have evidence that backs this up. Research indicates that a greater sense of control over one's life explains a full 74% of the correlation found between income and happiness. So optimization is not fundamentally about greed. It is about building a buffer that grants you the power of optionality, the ability to say no, to leave a toxic situation, or to weather an unforeseen crisis without fundamentally disrupting your life.
Okay, that 74% correlation is a powerful statistic, I grant you. But I disagree that control over the balance sheet necessarily equates to control over your life. If the optimization path is rooted in a fundamental, unexamined scarcity mindset, that perceived control can be an illusion. It's often perpetuated by what we could call behavioral inertia.
What do you mean by behavioral inertia in this context?
I mean that the successful individual maintains a spending reluctance that they developed in their leaner years, even after their net worth has grown exponentially. They know they're rich, but they operate as if they are broke. And this perpetuates a feeling of being stuck. The need to optimize becomes a habit that traps them in high-stress roles, trading their most precious, non-renewable asset, their time. Let's put this in stark temporal terms. A person at age 20 is a time billionaire, right? They possess roughly 2 billion seconds of life remaining. By 50, that figure is halved to 1 billion seconds. Continuing to prioritize maximizing the bank account over maximizing the time account by trading those peak utility hours for dollars, well, it represents profound capital inefficiency. The enjoyment utility, the fulfillment generated by money spent on an adventure at age 30 is infinitely higher than the same compounded dollar spent at age 80, when your physical capacity is declining. The marginal utility of that dollar toward maximizing life fulfillment hits zero the moment you cannot physically benefit from spending it.
I'm not entirely convinced by that line of reasoning, because you're imposing a sort of arbitrary, rigid ceiling on security and happiness. It's based on a diminishing marginal utility curve that, frankly, may not apply to the majority of high earners. If we look again at that influential 2023 collaborative analysis by Nobel laureate Daniel Kahneman and Matthew Killingsworth, they found that for the majority of people, subjective well-being and happiness continue to increase, and for the happiest individuals, this trend actually accelerates with income well beyond the conventional $75,000 plateau. It could be up to $500,000 and beyond. So why should we enforce a behavioral break or pivot if continuous strategic optimization offers genuine, albeit logarithmic, psychological benefits?
That is a crucial counterpoint, and it relies on a very important distinction I want to make. The same collaborative study highlighted a key nuance. For the least happy 20% of people, the individuals struggling with mental health issues or significant personal trauma, emotional well-being effectively plateaus around $100,000. For these individuals, more money is literally unable to purchase more happiness. So if the relentless pursuit of optimization is itself generating the internal misery, the high-stress environments, the professional sacrifices, then that wealth becomes a neutral or even a negative factor. And this brings us to the true hidden cost, the golden handcuffs trap. This is where a high income creates a gilded cage, locking the earner into a specific, high-stress career because their lifestyle has inflated to match their income. This makes exiting impossible without a catastrophic financial loss, simultaneously destroying their capacity for joy.
But surely that's a behavioral problem, not a rational indictment of optimization itself.
It is the systemic risk of the optimization path. Moreover, we have to account for biological debt. The physiological toll of maintaining a high-stress, high-earning career is not free. Financial or professional stress, even the stress of managing undesired resources, it's directly linked to increased cardiovascular disease risk and increased mortality. Every year of over-optimization, where you trade health for marginal wealth, creates a debt that compounding interest won't fix. You are maximizing money at the expense of the long-term biological capacity required to enjoy it. That is the very definition of capital inefficiency.
That is a compelling argument regarding the physiological cost, I'll admit. But I return to the professional mandate for high earners, particularly in high-stakes fields, law, medicine, finance. The primary professional duty is to avoid the harm of commission, making a wrong decision that causes a measurable, regrettable loss. Therefore, in financial terms, the rational default is the safe omission of saving, avoiding the regret of spending money on an experience that turns out to be not worth it or taking on undue risk. And this impulse is formalized in, well, actually it's described in psychological literature as omission bias, which suggests that people tend to feel stronger regret over negative outcomes resulting from action compared to inaction. For the rational optimizer, avoiding market risk or lifestyle creep preserves the flexibility to handle life's genuine catastrophes. Avoiding action is the safest hedge against a measurable mistake.
I come at the issue of regret from a different foundational principle. You're applying an investment protection strategy to life fulfillment, and I would argue those two spheres operate on fundamentally different axes of regret. While financial rationality prioritizes avoiding the regret of commission now, that is, don't buy the experience that might be a waste, late-life psychological research shows that the deepest and most enduring regrets are overwhelmingly those of omission. The things one didn't do. The relationships not nurtured, the time not spent, the experiences permanently postponed. I mean, when you're 80, are you more likely to regret having too much cash or having spent that money on a trip that was simply fine at age 35? I highly doubt it's the cash. We are debating the conversion efficiency of life energy. Choosing to work one more high-stress year to add $1 million to a retirement account when you are already financially secure is a permanent, non-recoverable loss of time that had peak utility experiential value. You can always recover from a financial loss. You cannot buy back the energy and time spent with young children or the physical capacity required to climb mountains. The asymmetry of regret in life utility terms, it favors experience over accumulation.
The irony, though, is that the strategic experiential spending you advocate for now, while it maximizes present utility, may lead to catastrophic future losses down the line, especially if you haven't properly hedged against those 119% healthcare costs we talked about. This forces asset sales later and ultimately robs you of the very optionality and control you believe is irrelevant to happiness. The pursuit of net worth is, therefore, a necessity. It's an essential, sober hedge against compounding unpredictable risks of the future. Optimization is a permanent commitment to maximizing freedom over one's future circumstances.
And my argument remains that the optimal path has to be a dynamic one. It requires a clear and intentional pivot point. Once that baseline of security is firmly established, the diminishing returns of continued wealth accumulation are, I believe, overwhelmingly outweighed by the accelerating decay of time and biological capital. True life fulfillment, the maximization of that memory dividend, is achieved not by waiting until you have enough, but by strategically spending money when your biological capacity for joy and experience is at its highest.
We clearly hold starkly different views on the optimal regret mitigation strategy, but the material highlights something crucial here. This is less a financial or mathematical problem and far more a deep psychological confrontation.
Precisely. One side seeks safety, control, and agency in the immutable, measurable numbers of the bank balance, convinced that security must always be the priority. The other seeks utility, meaning, and fulfillment in the fleeting, non-recoverable nature of the moment.
The ultimate decision, therefore, requires that the high earner confront a profound internal question. Are they truly optimizing their money and their resources for a better life? Or are they simply using the goal of optimization as a perpetual shield to avoid the discomfort of deciding, right now, what truly matters in their finite life?